Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Last night, Chairman Powell lifted US interest rates by 0.5%, the first time we've seen a rise of this magnitude since 2000. The decision was unanimous. Governor Bullard did not dissent as many had feared. Markets broadly welcomed this decision, especially the comments that a 0.75% move was not considered by the committee. Nevertheless, this is aggressive. The chairman indicated that we can expect to see further 50 basis point rises at the June and July meeting, taking us rapidly to neutral by the end of the summer. The phrase he used repeatedly was expeditiously. In addition, of course, the Fed will start to reduce its vast holdings of US Treasury bonds, and it will do so from the 30th of June at a rate that's almost double what we saw in the previous cycle. So in the slides that follow, we will ask, why is this aggressive twin track policy needed? What's the policy error which led to these huge inflation overshoots? And what are the implications for your portfolio and asset allocation in the months ahead? Let's begin by looking at the first chart, where I show US base rates in red. You can see the recent uptick, and in blue, the Federal Reserve's preferred measure of inflation. That's called the core PCE deflator. Now you can see that inflation measure starts to rise quite aggressively from the end of 2020, but it's some time before US interest rates actually respond. So why the delay? Well, part of the reason was a policy change that occurred back in August 2020 called flexible average inflation targeting. I reported on it in one of these podcasts. What the Federal Reserve essentially said was that if the economy was coming from a period of weakness when inflation was lower than 2%, then policymakers would deliberately allow that inflation rate to overshoot above 2% to compensate. In other words, the tightening cycle was always going to be late. This was doubly unfortunate, as it turned out, of course, because it coincided with a massive fiscal spend by the Biden administration and, of course, deep supply shocks across the COVID period, which pushed up prices of goods and services. So what does this mean for Chairman Powell's priorities going forward? Well, the most important issue for him is to anchor inflation expectations. And I've shown on the left-hand side that one-year inflation expectations have risen sharply up to 6.5%. 3 years is a bit more contained at 3.7%, and 5-year expectations are still quite well held down around about the 3% level. This means he's going to have to move fast to anchor those numbers, and hence the comments that inflation is much too high, we understand the hardship it's causing, and we're moving expeditiously to bring it back down. Very similar words from Lael Brainard, the Vice Chair. So this is a relatively urgent policy by the Fed to anchor those numbers. What does it mean for policy? Well, they've got to raise policy enough to take demand out of the system. They can't, of course, in the short term, much influence supply. And that demand will be primarily in the labour market. Remember, at the moment, we have double the number of vacancies or job openings that we have unemployed. That's unprecedented in recent economic history. So my view is they'll raise and continue to raise till they get to the neutral rate and a little above. Our more hawkish scenario takes rates up to 3%. Our base case takes them up to 2.5%, as doing enough to cause this underlying shift in demand. That, of course, looks nice and easy, but of course it's full of uncertainty. First of all, they're operating QT or balance sheet unwind at the same time. And secondly, of course, monetary policy operates with long and variable lags, at least 18 months before it's really felt in the underlying economy. So the possibility of policy error is high. What does this mean for longer term inflation? Well, I've shown here the US CPI peaking today at 8.5%. We expect about half of that rise to fall away quite quickly and relatively easily as base effects drop out of the numbers. In other words, the one-year increases of food, energy, oil and gas that were so large fall out of the index if the year-on-year numbers going forward are broadly flat, which is what we're predicting. The difficult bit will be getting inflation down from 4.5% to nearer 2%. We expect the Federal Reserve to be satisfied with a number slightly above 2, and we see them holding inflation somewhere around the 2.7 to 3% position from 2024 onwards. What could go wrong? Well, of course, Paul Volcker found that he needed back in the 1970s much higher real interest rates to actually crush inflation. I've shown the numbers here on the left, and you can see those very high US real interest rates in the early 1980s and early 1990s. We're not predicting anything of that magnitude, and it might be that these higher interest rates are needed. The problem with central banks are that if you raise too far, you begin to impact heavily indebted governments around the world who will find the burden of the post-pandemic borrowings almost impossible to sustain. What does this mean for financial markets? Well, broadly they're behaving probably as the Chairman of the Federal Reserve would like. They're broadly falling. Bonds and equities dropping simultaneously, very unusual. We've seen a modest rally after the announcement last night, but in general markets are reacting negatively to rising interest rates, which is probably what the Chairman wants to see as policy tightens. On the right-hand side, I've shown the US dollar index rising sharply. That'll help to offset inflation, though of course make the problem doubly difficult in Europe and the rest of the world. Put together in the National Financial Conditions Index, this is the tightness of policy. You can see that drifting upwards over the last few months, probably again what the Chairman wants to see. So for investors, what do we take from this? The Fed will move expeditiously and in my view quite aggressively. This will be quite challenging for investment markets, even with underlying earnings and dividends quite robust. It'll provide further challenges for the bond markets and probably increase volatility. But the broad direction of policy is the right one, and there is confidence in the Federal Reserve's policy, and this is ultimately good for asset class returns. Thank you.